Um, Good evening. Sorry, it's always tricky to decide when exactly to start because some people filter in a little late. Good evening. My name is Mahmoud Al-Gamal. I'm a professor of economics here at Rice, and I'm also currently serving as the Will Clayton Fellow for International Economics. See, Mansoor is not the same height as I. It's 3 days after Halloween, and we have a scary treat for you guys. It's a bit scary because we don't like to think about how much the world is changing, but it's a treat because Dr. Mansoor Dailami, who's our speaker today, has assembled together a great team of forecasters at the World Bank. He's the manager of the Emerging Global Trends team at the World Bank, and they put out this flagship publication, the Global Development Horizons, which has been catching fire around the globe. So he's been literally globetrotting, presenting this everywhere from Beijing to California and in between. And we were very fortunate to catch him in Houston today. So he'll speak to us about the report that he just published, and then be happy to field any questions that you have. So please join me in welcoming Dr. Mansoor Dailami of the World Bank.
Well, thank you, Mahmoud. And good evening, ladies and gentlemen. As Mahmoud mentioned, I work in the World Bank in Washington. And after being in the international organization for 30 years, I've been given a very interesting job. Basically, I've been paid to think about how the world economy could change in the next 10 and 15 years. We obviously have a team doing a lot of detailed modeling, detailed econometrics work. But the beauty of that is, by the time I come up and make some prediction, probably I have retired from the bank. And nobody can take me account for that, whether I was right or wrong. But at least I think the type of work we are doing is really partly in response to the latest crisis of 2008, 2009, and a lot of discussions that the world economy, the world around us is going to change after the crisis. There were people talking about the end of history, the end of Anglo-Saxon mode of finance. I don't believe it's the end of history, but definitely those crises and the subsequent changes that we have seen in the economy, the world economy, do point out a future that's going to be different in many respects from the current situation and definitely from the previous one. Now, in giving a context to my talk tonight, I came across this speech delivered by Secretary Baker, I think it was March 1993, when this institute was established. He mentioned 3 points that I found very interesting. One, he talks about the power of ideas and how to bridge ideas with action. Those who are actually in real life, either in policy making, in the business, how they can use ideas which is developed in academic institutions, the intellectual community, to help day-to-day life of the ordinary people. The second one, he mentioned that it's very important when we look at international relations, diplomacy, that we pay more attention to economics underpinning of those international relations. We just don't look at them purely from a political point of view. And the third one, he said that, is increasingly with the globalization, with the interdependency, the day-to-day livelihood of American citizens going to be affected by events taking place outside the country, in different parts of the world. That's part of the globalization. And I hope in my speech tonight, I can give some concrete example of what the Secretary mentioned over 20 years ago really has a lot of bearing even today. Number one, in terms of ideas. I worked on India in 1991. the time the country was running a major balance of payment crisis. Their foreign exchange reserve had dropped to the less than 2 weeks that they could sufficient for imports. Rajiv Gandhi was the prime minister, had been assassinated. A new government came into power. But it was the idea that they could change policies. They could integrate their economy with the rest of the world. They could undertake reform that motivated the government. And since then, we had seen India growing at 8.6% in recent years. The foreign exchange reserves have increased to close to $280 billion. In 1991, the whole foreign direct investment was about $74 million. Today is close to $24 billion. I give another example, Korea. 1960, Korea was a poor country. Today is an economic powerhouse. I was just in Korea in a conference a month ago. The whole conference was trying to look ahead how Korea become more important, map out the future course of Korea. And believe me, for somebody like me who have been observing these countries moving along the development line, from poverty to become middle class to become prosperous, nothing is more enjoyable when you go to a country that you see so confident of their destiny. And they talk about today how to share the experience of Korea with the rest of the developing countries, to teach them how to manage their economy, how to open the industry, how to promote the private sector, how to bring foreign capital in a more productive way. And they have a lot to teach the other countries of those successes. Now, I want to basically talk about three major issues tonight, three observations. One, when we look into the future of the world economy, there are going to be important changes in the structure of the economy. You're going to see countries like China, India becoming much more important. In fact, we estimate that China, in terms of economic size, could take over United States by 2024 or so. But although in economics, those countries become important, on the political aspects, the United States will remain the predominant country. When you look at other aspects of power, the United States would still be the dominant power. Therefore, for the first time in modern history, you're going to see on economic issues other countries competing much more with the United States, where the political, geopolitical, military, other aspects of power, the US still would be number one. There is going to be some divergence. The third point that I would like to make is that looking ahead, it's still the leadership that the United States would bring about to hold the international economy, which becomes very important. And part of this leadership is to preserve the whole structure of the world economy, which is the openness, the capitalist system, that the United States was so critical in designing and preserving and in maintaining since 1944 after the Second World War. I think this so-called the liberal project, make the openness of the world economy becomes very important. And the US has a very critical role to play in that respect. Now, I just talked about, we did some basic projection, forecasting of different countries. We look at the United States, what is the potential to grow, how it will grow from now until 2025. When you look at China, you see that China, in terms of economic size, most likely is going to become larger than the United States, sometimes about 2024. Other people have talked about maybe sooner. But generally, I think by now, there seems to be kind of consensus that in terms of economic size, China would be larger than US economy in the next 20 years or so. We look at obviously a large number of countries. The United Kingdom, Japan, and even India would overtake the UK and Japan. There are a lot of reasons behind why these countries are growing at this rate. One of the basic fundamental reasons is demographic factor. Many of these countries, they still have much younger population. And it's really the younger population, it's called the demographic dividend, which is going to contribute. Now, if you look at obviously China has already become aging much sooner than other countries, but Brazil, Indonesia, other countries, they have a young population. This curve basically looks at the proportion of a country's population, age of 15 to 59, which is the working population, of a total population. This is going to be a very important factor. The second important factor, which is driving these countries to grow at a relatively high rate and continue to grow, is really technology. The way in which many of these countries have been able to adapt technology which is developed in other countries in the manufacturing sector, in their industries. We look at many indicators of technology, how a country has the capacity to either innovate new technology or to adapt technology. We look at, for instance, the university structure, the number of scientific papers. But it's very interesting, even when you look at the number of companies from these countries that they are investing in research and development. Go back to even 2000, there was a very few companies that they were investing in research development, more than 1 or 2% of the total sales. But today, when you look at, you see more and more companies from these countries are becoming very important in innovation. When you look at patent as another indicator of technology, again, the same indicators that on technology front, many of these countries have become very important, both in terms of innovation as well as adaptation of existing technology. The other important factor which is changing is not this country growing faster or for a longer time. It's really what is happening at the corporate sector. We look at the thousands of companies from these countries. Many years ago, when you go to these countries, these companies were very much, their sales, their financing were confined by the domestic markets. They were relatively small companies. But they have been growing, they're becoming internationalized. We look at many indicators. For instance, when you look at the number of companies from developing countries, from China, from India, from South Africa, from Mexico, from Indonesia, from Malaysia, these countries are investing in terms of cross-border merger and acquisition in other countries. The number is growing. These companies now, they have been able to have access to international financial market. They can borrow from international banking system, they can borrow from international bond market, therefore they can grow much faster. The constraint that existed on many of these countries even 10, 15 years ago, that they could not borrow from the outside, today has been removed. Some of the Indian companies, I remember even 10, 15 years ago, they could not go outside to borrow because the government put a lot of restriction on them. Today, many of these companies have become global companies. They come to New York, to London, to Frankfurt, they can issue bond, they can issue borrow. Therefore, the financing, which is very important constraint in the past, is being removed. These companies are becoming global companies in terms of investment in other countries, when you look at them. When we look at how much these countries are investing in these companies in other countries, quite a lot of them are investing in the United States, buying existing assets, other companies. And these are companies, again, from variety of countries. Many of them in the banking sector, in the energy sector, in the manufacturing sector. It's not just confined to 1 or 2 sectors. Again, when you look back, go back to 10, 20, 30 years ago, much of foreign direct investment were going from United States, Western Europe, Japan to these countries. Today, foreign direct investment is becoming multi-directional. You see countries from India, China invest in the United States, United Kingdom, in other developing countries, as companies from the United States invest in others. Therefore, the whole equation of foreign direct investment is really changing. It's not from the countries, advanced countries, industrial countries, to developing countries. is becoming much, therefore, there's going to be more competition over natural resources, over labor, over markets, because these companies are today becoming large enough and have access to the markets that they can compete with the established multinationals. Now, I talk about two aspects of this change that we talk about, how this paradigm change. The third one, which is going to be very important, is the terms of the whole international monetary system. For the past 60 years and so, the whole world economy has operated based on the dollar as being the primary dominant currency of the world. Much of the trade takes place in dollars, oil, gas are denominated dollars. Countries borrow in dollars, and countries invest their reserves in dollars. And that has been the norm for many years, and the dollar would continue to be important. However, there are other currencies which are going to become important. Again, to put that in the context, if you go back historically, before dollar obviously was the British pound. From 1860 to 1940, the British pound was the dominant international currency. Dollar took over from British pound sometimes around 1940, 1920. I mean, there is something around that. But when it comes to the 1930s, we had more or less three currencies, which was the dominant currency in the world economy. You had obviously dollars, the pound, British pound, and French franc. In the 1980s, we had the three currencies as the major international currency: the dollar, the Deutsche Mark, and the Japanese yen. Now, if you look forward, try to project, gaze into the future, let's say by sometimes around 2025 or so, most likely you're going to have three currencies. The dollar still will remain, the euro, and the Chinese currency renminbi. Now, when we came back with this publication a couple of months ago, and we talked to the press, media, people accepted the dollar and said, despite all of these problems, the dollar would remain a major international currency. And the euro obviously is going through a rough time, which we're talking about now. But the one that everybody was concerned said, Chinese currency, how could it be an important currency? But there are many strong reasons. Now, before I get to the Chinese currency, let me just talk briefly about euro. Now, the euro is going through a rough time now. It's rough time because of the debt crisis in Europe, in Greece, in Ireland, in Portugal, which is now affecting Spain and Italy, and the whole existence of euro is being discussed, whether it will remain as an international currency. We believe the euro would survive this situation for a number of reasons. Number one, I think so far, this crisis has been a sovereign debt crisis. Many of these governments had borrowed too much. They could not pay back the debt. Greece, obviously, number one, Ireland, and Portugal. The euro has still remained relatively intact. But the other reason, which is very important, is because the markets have not been yet convinced that the Europeans have come up with a solid solution. It's becoming like a game of a cat and mouse. The officials from European countries come up with some measures. They think the market will buy it. The market would buy it for 1 or 2 days, then again go back. And the best indicator is that when you look at any indicators of the market confidence, how the markets are pricing the debt of European countries. Here, for instance, we look at various measures announced, policy reform announced, but you see the markets 1 or 2 days, they kind of stabilize, but they go back again continuously. That means still there is not enough confidence in the markets. And I think there was a number of reasons for it. Part of the problem was that the Europeans from the beginning, they treated this problem as a European problem, and they thought they could come up with European solutions. I remember when the Greece problem came up in Ireland, a lot of people were saying that, look, this has the potential to become a global problem. Therefore, you need a global solution. They say, no, no, it's a European problem. It's of a backyard. We can solve it. They didn't even come to the IMF for a long time. And the markets day to day got situation worse. But if you compare that very interestingly to the 2008, the subprime crisis in the United States, because that is starting in the United States, I think the smartness of the Bush administration was that very soon they realized that subprime crisis has the potential to spread to the rest of the world. They said this could be a global problem. Therefore, it needs a global solution. That's why in 2008, President Bush at that time put together, basically called the G20 as head of the states, brought all the major countries together. Head of the states, the first meeting in Washington, they said, look, I know this problem is starting in the United States. In fact, it started, some people say, in California, the subprime crisis. But in today's world economy, that the banking system was so integrated together, the financial market so open, it's very difficult to contain it just here. You do need to bring the whole international economy. And it was very interesting. I remember at that time, part of my job was just to monitor the markets on a day-to-day basis. I would wake up every day like 4 o'clock, 5 o'clock, look at the Asian markets, have to write a few one-pages for our senior management, what's happening to the market. And there were times that day after day you see the markets are dropping. Equity markets dropping, the debt markets, its price going up, and frankly, everybody was concerned because it was becoming a major global financial crisis. But what changed the market sentiment was when they saw President Bush could bring other countries together and a united front, they said the governments stand, they do whatever it takes to restore confidence. You see, the markets need to have the confidence, and the confidence is a very touchy, difficult situation. I mean, we have done a lot of research. It's very difficult to say what it takes that suddenly the markets become convinced that the government policies are the right one. But one thing which is very important, when they saw the whole head of state and major governments together, they said we would do whatever it takes. And that's why they started basically the summit of G20, which is continuing. It's going to actually meeting today in Cannes, France again. And that was very important part of the solution. With the European problem, I think part of this problem was that they did not look at it as a global problem. In today's environment, when the banks, market, financial market is so integrated, it's very difficult to say I can confine this problem just in that region. It could spread very quickly. We have seen that historically now. And I think this chart shows very nicely that still the confidence has not been restored. Now, the latest action, which was the Euro summit that came last week, hopefully that would have some impact, but we still have to wait how that is going to be affected. But again, when you look at from the historical point of view, how much the Europeans have invested in the so-called single market, in the integrating their markets together, I would believe that political will would continue. Now, it's very difficult to say whether all the 17 countries which are members of the Eurozone will remain together, but I think Euro as a currency would most likely survive the current turmoil. Now, going back to the Chinese currency, why we believe that Chinese currency, which is renminbi, would become an international currency. Number one is based on the size of Chinese economy and the size of the trade, how much they're trading, with the number of countries they're trading. And then it depends on government policies that they are put together, and they're moving very in a gradual, pragmatic way. One thing I've worked on China for many years, traveled, I've always been impressed again and again is by the sense of pragmatism. They look at the problem, they say, okay, this is going to take so many years, let's solve it, but step by step. They don't make very ambitious big solutions because they know the real life is not so easy. You need to take it step by step. In fact, there's a Chinese proverb, crossing the river step by step, stone by stone. Don't jump it, just go step by step. And I think this is characterized how they do policy reforms. I've seen that again and again. And in this respect, they have put together a very clear strategy. They say for renminbi to become an international currency, number one, it has to be used more and more international trade. Countries have to conduct a trade denominated renminbi. Over the past 2 years, you can see how much has increased because they've been promoting that. Almost a year ago, virtually not much of a trade, even from China, were denominated in renminbi. Mostly was in dollars or euro, British pound, or Japanese yen. But it's increasing in a phenomenal way. Because when the Chinese trading with Brazilian commodities, they say, look, rather than price it in dollars, just price it in renminbi. When the Chinese are exporting to other countries, they are trying to promote that. We estimate by now close to 8% of the total Chinese trade is done in renminbi. If you look at the size of China trade, it's about $3 trillion. It's growing at least at 20%. Just calculate that in the next 10, 20 years, you're going to see quite a significant part of world trade being conducted in renminbi. They're doing something else which is quite interesting. They're using Hong Kong as a kind of offshore market. The reason that they don't want to open the whole mainland country to the financial flows, because they're concerned they may lose control. But they say Hong Kong is there. Why don't we start with Hong Kong? Let the banks in Hong Kong issue deposit and lend in renminbi currency. And let's see how this is growing. It gives them a tremendous ability. See, they have control over the mainland. They haven't opened Shanghai to that. They opened Hong Kong. And gradually they see how this is working. They see, for instance, the banks are giving more, accepting more and more deposit in renminbi. They're lending in renminbi. They see companies, even from the United States, including McDonald's, issued bonds in renminbi. But in Hong Kong, they let Hong Kong to be that kind of offshore market. And let this market grow. And this is basically shows how even this market is growing. More and more companies issuing bonds in renminbi, banks transacting in renminbi, and let that grow. Again, you see this significant growth. But very soon, financial markets, big financial institutions, are going to believe that is going to be an upcoming market. This provides a significant amount of profit for them, and they're going to develop this market. They let the market themselves develop themselves. As a policymaker, you just provide the framework. The rest is undertaken by the markets. Now, I talked about the fact that China, in terms of economic size, may overtake the United States, and the United States, on the economic side, may have to face other countries become very important. This is called the multipolar. The world economy will be like a multi-engines of growth. The United States is not going to be the major engine. Growth will be driven by several other countries. But it's very interesting that when you look at other indicators, what we traditionally call economic power or economic importance, the United States is going to be the dominant power on the political side. For instance, one indicator is the income per head, which is a good indicator of how rich or poor countries is. United States is going to be much ahead of China and other countries. When you look at, for instance, the defense expenditure, when you look at the technology, any indicator, the United States is going to be significantly ahead of other countries. Even if you add up China, Japan, and South Korea together, United States is going to be superior in many of those indicators. In terms of income per capita, in terms of defense, in terms of technology. And this is going to be very interesting because historically, from at least 1944, 45, basically after the Second World War, until recently, which we call the kind of Bretton Woods era or post-war era, the United States was the dominant economy and the superpower in political and technology and everything. But the US would lose its relative importance and economic size. And this is going to create some tensions in the market. Now, another indicators, if you look at income per head, which is a good indicator of how much wealth a country has, basically look at the GDP divided by the total population. This chart shows the income per head for the United States from 1870s, I think, from 1870s, all the way to now. You can see how basically is a good indicator of how the United States have become rich, how an individual income has grown over time, over the past 2 centuries, basically. But it's very interesting that when you try to see how other countries compare to the United States, for instance, if you look at, for instance, India today has the same level of income per capita that the United States had sometimes about 1890. If you look at China, has the same level of income per capita that the United States has almost 1940s. Even Russia, let's say 1950s. That means they are, with some respect, they are still years behind. This is a very nice indicator of trying to put things in perspective. Because economic size is one thing, income per capita, which is really very important indicator of well-being, social development, is another. Even South Korea is where the United States was in 1990. Therefore, in terms of income per capita, you still have a long. But it's very interesting that if you had done this chart for China, you see China catch up with the US every 10 years, what US had done every 50 years. For instance, if you go to China instead, you see basically China travels the road every 10 years when the US did every 50 years. And the same for India. India does it every maybe 15 years, what did China? You can really get a good sense of this is basically you can look at the race, different horses running. Some horses take advantage of the several comparative advantage. And that's why, again, going back to this comparative advantage when you look at different countries, how they are going to grow in the future and how they're going to import them. Now, where I think everybody is concerned about, then the US is not just even in economic size is one thing. But as I said, in other attributes of political economic power, the USSR is going to be much ahead of other countries, even for the next maybe 10 or 15 years. But there are two aspects of the US economy that right now markets and policy establishment are very concerned. One is the huge fiscal deficit and the significant growth in public debt. The other one is basically the other side of this deficit, which is the deficit the United States is running vis-a-vis the rest of the world. And that has been growing year after year. If you look at the current account deficit in the United States, I mean basically how much the US vis-a-vis the rest of the world, in principle, it should be balanced. You buy commodities from goods, you export to them, or somehow you try to balance. Basically, the US since, I would say, 1992, has been running year after year current account deficit. The consequence of it is that what? Is that if you're running current account deficit, then you have to borrow from other countries to be able to close your books. Whether it's a country, as a company, or as an individual, it doesn't make any difference. We do that, right? Every year, every month, you look at your income. If your expenditure is more than income, the only way that you can go on is there has to be somebody to lend you. If you can put your house or get equity loans, okay. If you can borrow from your friend, it's fine. But can you do that year after year after year? Sooner or later, even your best friend is going to look at you and say, look, I mean, you have to put your house in order. I mean, you know, I've been trusting you, I've been lending you, but somehow you have to make your books balanced. Now, this has been going on in the US quite a long time. We went back again from 1940-46. It was very interesting. In the early 1950s, 1960s, if you look at United States financial trade transaction vis-a-vis the rest of the world, by 1960s, the US had enough in terms of the commodities and goods and services, the export surplus, and had enough income from investment that had made outside. Because as a country, exactly like individual, either you sell to other countries more than what you're importing, or you have income on the assets that you have that covered 4 of the main objectives of the government. It was enough to cover how much the US was providing to other countries in terms of foreign aids, in terms of how much the US private companies are investing, and how much US had military establishment. But if you come by mid-1970s, export accounted say became negative. Then the US was importing much more than exporting. Income on assets abroad continued to grow, but it wasn't sufficient to cover other funding from outside. And I think this is really what part of the issue that people talk about, the future of the dollar, is really how much the market is going. Now, if we look at, for instance, I think it's 2010, the US basically had a deficit of close to $417 billion vis-a-vis the rest of the world. China had a surplus of $305 billion. All exporting countries, 132. Then as a result, China became the major creditor, the United States became the major debtor, if you look at it in the global context. Now, Chinese so far have been buying the government treasury bills quite willingly. But the question everybody asks, how long can it go on? Today, China has close to 1/2 of the total treasury bills China holds. Now, what are the implications? I like to just highlight on 2 aspects. I think there are 2 markets that people are very concerned about those changes that are coming up. One on the energy market, particularly the oil, and secondly on the financial markets. If you look at the oil market, the first chart here, it shows the price of oil from 1951 till today. This is the real price of oil. Basically, we get nominal price of oil per barrel. Used to be about $2, $3. We deflated that by an index to bring it in the real terms. It's very interesting that to see until almost 1970, 73, the price was, in fact, in real term declining and stable. Then we had the first oil price shock, then the second one, and then we had the last couple of years the price of oil went up summer 2008 to 145. It's very interesting that this increase in price of oil was not so much driven by the world growth, because the other chart look at the world growth, how much the world economy as a whole has been growing by 3%, 4%, 5%. In fact, in the early years, the 1950s, 1960s, as a part of the whole reconstruction of the Europe, the world economy was growing very high. In the recent years, in fact, has been declining. Then, therefore, there has been other factors driving the oil prices. Simultaneously, when you look at financial markets, go back again to August 15, 1971, when the President Nixon delinked dollars from the gold, moved from the gold standard, and the world economy moved to a kind of floating exchange rates. Therefore, the discipline that existed through the gold standard was removed. As a result, especially countries that they have international currencies, the United States, the European countries, today there is no constraint on them. They can borrow as much as somebody is willing to lend them. There is no institutional constraint. There's no fundamental economic constraint. It's only a confidence constraint. to the extent to which somebody is willing to do this. But this is not going to go on. I think the question is that how long that might continue. Now, again, when you look at the different components of energy markets, you see quite a divergence in the oil prices, gas, and coal. And the whole energy market basically has become very much fragmented. Oil being driven by different regulatory issues, economic forces, gas, particularly huge amount of technology development, particularly if you look at liquefaction, and coal is being very much driven by the environmental concerns. When you look at the energy market again globally, one area which we see a lot of investment need, a lot of needs in the electric sector. If you look at, again, developing countries as a block compared to developed countries, today electricity consumption per capita per household in developing countries is almost 1/10 of developed countries. For instance, in developed countries it's close to 9,000 kilowatt hours. In developing countries, about 1,300. Now, when you look at population growth in developing countries, let's again make the same calculation as we did previously. Look the next 20 years. How much population is going to grow? And we have a very good data on population growth from the United Nations Population Center. There's one area that's an economist, we feel very confident, is on the population size. Because you can really do good calculation how much the world population is going to grow. Then if you calculate how much electricity developing countries need to satisfy the new population growth, and how much they need to raise electricity consumption per capita to a higher level as they industrialize, as the middle class grow, therefore demand for electricity will grow, you come up with quite huge numbers. For instance, by 2025, we estimate close to $2.1 trillion of new investment they need. And this is quite a substantial number. These are the numbers that, again, just in their population. Now, for a number of years, my job with the bank was going to different developing countries, working with them, helping them how to design regulatory system, how to bring private sector investment in the transport sector, in the electricity utilities, in the various infrastructure sectors. You see that most of the government realize that there's a huge demand. You go even to India today, they have so many hours of blackouts. Electricity ran out, even in Delhi, for instance. Many parts of Delhi, after 6 o'clock, you don't have electricity. Even the area that the prime minister is in this is a major issue, even today. Many countries see electricity is not sufficient to satisfy the demand. They realize this is demand, and they want to bring private sector. They have accepted the fact that governments don't have the money, the budget, to be able to finance so much investment in infrastructure. But the difficulty of bringing private sector is you again need to provide the confidence to a foreign investor that's willing to invest a couple of billions of dollars to build a power plant of, let's say, 1,000 megawatt to 2,000 megawatt in India or in Brazil or in Indonesia. Because as a foreign investor, you say, look, I am going to invest a couple of $1 billion in a power plant. What assurance do I have that I get my rate of return? Because there's a political risk involved. There's a risk of regulatory issues. There's not a clear regulatory issues that electricity tariff will be a certain degree. And many of times you have to sell your electricity to existing state-owned electricity company, and you're not sure they will pay you back. And believe me, we have seen so many big contracts which has run into difficulties after the investment being made. There are roads in Thailand, in Bangkok, half finished. Foreign investor came, did it, half finished, they left. It's a very interesting, as I say, 6 years was my job, going to the government, talk to them, how to bring private sector, what are the needs of private sector, what do they need? And even from the beginning all the way to the concession award, all of that. But the good question is when you look into the future again, look at the demographic factor, Look at where the demand is going to be. A lot of these big investments are going to be in developing countries. Energy demand generally in OECD countries, oil consumption is coming down. Where is growing? Again, is developing countries. I think these are the type of future that we have to accept more or less as the reality is coming true. Maybe not the next 10 years, but in look 10, 20 years. These are really the issues that we have to face as we look future. Now, the other really important, I would say, challenge is the bilateral relation between the United States and China. Right now, you have a kind of mutual interdependency. Because as I said, China has become the largest creditor for the United States. Then you need China because they fund the treasuries. And China needs the United States because it exports to the United States. Go to every supermarket, look at things made in China. This mutual interdependency has been so far very good. But again, this is a mutual interdependency, it's not stable. You have to think out of the box again. I mean, this is great so far, but how long that again can go on the current policies? It's very interesting that I talk about why we believe China's currency become important. When we look at the distribution of how many countries China is trading, for instance, just a very simple calculation, they count in the number of countries that China is the either number one and the number second major exports. You come up with over 60 countries. And it's not only countries in Asia, but a lot of countries in Latin America. For Latin American countries, for Brazil, Mexico, Chile, China is becoming an important trading partner. Is the number one or number second? When you compare that to the United States has less countries that depend on the United States for trade, almost 50%. And much of it is in Latin America and some European countries. Then you see gradually China has been able to establish trade links with Africa, with Latin America, with Asia. These are the reasons that when they say the currency become important, it's not just based on simple calculation. Some of it is the result of years of establishing trade relationship. And these things takes time. Having 60, 70 countries that depend on you give a certain amount of power. And that is becoming very important how it could be used in the future. Now, let me conclude quickly. I basically mentioned that the whole structure of the world economy is going to change. We had the whole world economy dependent on the vision, commitment, and leadership of the United States. It has lasted so far. It has been very good for many countries. China, India, those have been the major beneficiary of the structure that the US designed after the Second World War, because they integrated the economies. The Western Europe was the beneficiary, the 60s other countries. But that structure is not changing. It's a kind of like success become the enemy of success. You're very successful. You're a very good parent in a way. You brought your children, but now they're competing with you. They're taking over somehow. It's not because the design was bad. No, the design was great. It was the best design historically from 1946 to 46. But somehow, this is now changing. And the change, as I said, is because this number of countries, not just China, India, South Africa, Turkey. I mean, we come up with a number of 14, 15 countries. In the next 10 years, they're going to become very important. And economic growth, economic size, gives them more confidence, gives them more ability to become important player in global decision making, in global what you call governance. And somehow, we need now to think about a new design to kind of incorporate their interest and respect their wishes. Basically, the US is moving away from having the structure that was US, Western Europe, Japan, now has to think about broader countries are becoming important. Already we see in G20, as I said, today in France, you're going to see the head of countries from India, from Mexico, from Indonesia, Saudi Arabia. They're all sitting with President Obama together in the same group, talking about the global issues. That's already taking place. But that's the formality. The difficult part is really you have to think about your economic policy and the reality that you have to compete at the corporate sector and at the national sector. Finally, I think it really, really comes down again back to the leadership of the United States. People are very concerned that say, going back to the 19th century, Britain was some kind of the hegemonic power. But the Britain promoted the open capitalist system. 20th century was the United States century. Again, promoted the open democratic reform system. When you look at the future, who is going to be one who is going to preserve and continue those ideas? And believe me, when you go back to the history, the state that we are today, despite all the problems, is much better than when we had in 17th centuries. We have had 60 years of, despite I said all of the problems, you have had 60 years of continuous growth. You have 60 years of relative peace, at least among advanced countries. You have 60 years of increasing democratization, first in Latin America, now we see even in the Middle East. And it's just a trend. But again, a lot of that was because the role that United States played, because it had the economic power, the vision, and the commitment. And now the question is that if China and other countries become more and more important, are they going to be attached to the same commitments of open capitalism system? And the only solution really is if you approach the problem through a multilateral framework, because they have benefited from the system. They see their interest in the system. And once they see their interest, then they have the interest to preserve it rather than challenging it. Let me stop here. Thank you very much.
Thank you very much, Mansoor. We only have a few minutes left for the formal Q&A period. Do you want to recognize your own questions?
Sure.
So.
Yeah.
You paint a very vivid picture of the importance of electricity in the future. What feedstock would you say will enjoy the greatest percentage of growth for the feedstock for electricity for the future?
I would say natural gas.
Do you feel the price will stay where it is or come down?
I think, I mean, actually, we had done several calculations. Generally, when you look at this fuel and other prices, I mean, natural gas for a number of reasons, because it still is not exploited as much as the oil. You have huge reserves in many countries which is not being properly used. Number two is the clean fuel, and it's more efficient than oil. The problem with the natural gas, it was not an internationally tradable commodity. Now with the technology of liquefied natural gas, which is becoming more and more available and technology developed, natural gas is becoming as much tradable as oil has been for the past 30, 40 years. I think the problem with natural gas was not the fuel as a commodity. It was just it had to be very much localized. The only way you could transport it from the field to other countries through pipelines. And the pipeline within the country is okay. But once you want to cross another country, there's a huge amount of problem. I mean, you know better than anybody else. That's the problem. But the liquefaction of natural gas is really addressing that problem. That's why I'm much more optimistic on natural gas. Yes.
Could you hazard a comment? We had a potential reserve currency, the yen, and could you, 15 years ago I was out here at a lecture and the Japanese were predicting the downfall of the yen 15 years ago. could you hazard your thoughts about why a fairly sophisticated economy has allowed its currency to deteriorate, or has it deteriorated as it might appear now?
Well, I mean, a currency become internationalized, not just because the government wants this currency to be. It all depends on the public, other countries, the private investor, the officials. It really is the others who recognize the currency as. I think that's actually the Japanese experience very interesting, because a lot of people go back to Japan. In fact, the government promoted internationalization, the yen, in the 1980s. Somehow the yen has not been able to be as successful, because if you look at any indicator, whether how much central banks are investing in yen compared to, let's say, British pound or Swiss franc, it doesn't add up very much. I think there were two reasons. One, some people blame Japan is being slow in opening their financial markets. They did not open their financial market, therefore they couldn't really help the international. Secondly, Japan has gone through a period of very slow growth. And they have not been able to kick that out. They've not been break of that kind of mode of low growth. And part of the problem with Japan is aging. The second problem that I think, sometimes don't accept is they don't accept immigration. I think, because the homogeneity country, it's very difficult. The country that's aging is not open to new people coming across the country. It's a very important part of the slow growth in Japan. You go to Japan, you go to the restaurants, you go to anywhere, you hardly see any other person working to Japanese. And you wonder, why? I mean, when this country has so much potential in that they could have been in the technology development as they were. I think that factors in Japan was three then, basically. They were very slow to open the financial markets, not being very open to immigration, migration of the others, coming to Japan as much as the United States has been open, and frankly, Europe, been much, much, much more open than China, than Japan. And therefore they growth it. And I think they have now accepted that with the especially Chinese currency gaining much more traction, it's going to be a losing battle for them. And they accepted the status quo as it is.
Well, it's 7 o'clock, so we have to stop here and thank our speaker again. There are refreshments outside, so we can continue the conversation informally. Please join me in thanking Dr. Dailami for coming to this.